Individual dividend stock investing versus dividend ETF investing. Which way is the best way to actually invest? What's going to get you the best returns? How can you have a happier and better life possibly? And which one's going to actually get you the most amount of cash flow? I brought my guy Ryan Williams on the channel here with me today, and after this video, go ahead and check out his channel if you haven't already for the best in the world of dividend investing. I'm also going to go over the best dividend ETF and going to give you 3 dividend stocks that you should definitely be looking at for 2025. Now this video is a little bit longer, just going to tell you that straight up. But I promise you, this is one that you're going to want to listen to. So maybe just have it on in your car on your daily commute, or go for a run or something and listen. But this conversation is one between Ryan and I, and we're just talking about very important topics within the world of dividend investing. Like, why invest in dividends when you incur a tax? And what types of things should you put in your Roth IRA versus your taxable brokerage? This video is going to be great if you've never invested in dividends or if you have a full dividend investing portfolio. I think you guys are really going to enjoy the debate between ETF investing versus individual stock investing. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. All right, welcome to the show, Ryan. Good to see you again, brother.
Good to see you too, man. I feel like it's been a while since we've gotten to chop it up and shoot the breeze, so I'm stoked to do this.
Yes, definitely. Couldn't think of anyone better. We're going to be talking about some dividend investing, specifically dividend individual stocks versus some dividend ETFs. Later on in this video, I am going to ask you about a couple of solid dividend stocks that you're thinking about for 2025. So I do want you to be thinking about that. But for now, let's jump it off with something that a lot of people have kind of asked me lately. So I would love to actually hear it from you. What do you think is just an overall benefit, maybe like the top overall benefit for dividend investing just in general?
Where do I start? I think one really obvious one is just, and I would say this is probably one of the big reasons why I gravitate towards dividend investing. Someday down the road, when you're in retirement, think 10, 20, 30 years down the road, you know, if you do it right, you won't have to sell your shares in retirement. You know, the benefit that you get from owning those stocks comes from, it comes from share price appreciation too, and that's important. But one of the big benefits comes from just collecting that passive income, just getting those dividends. And so in retirement, you know, you don't necessarily have to sell out of your shares and liquidate all of those assets that you just spent the last, decade or couple of decades building up. And I think for me, like I said, that's one of the big reasons that I gravitate towards this style of investing, just to not have to, sell off my shares down the road. And that's not like an important thing to everyone. I think like the 4% rule, where you take withdrawals from your portfolio like that, I think that works fine for some people, but I don't know. I think for me, I've just always liked the idea of not having to do that, of having, another option aside from having to sell my positions.
Yeah, interesting. No, I definitely would agree with you. I think that is the overall benefit, the number one benefit, just cash flow, and specifically in an asset that you don't have to sell out at some point. And that's pretty cool.
What about you, man? That's, like I said, that's a pretty obvious one, but what other ones, or what's another big one that comes to mind for you, one of the benefits of that style of investing?
For me, it's just the idea of investing in something a lot safer than I think we're normally gravitating towards. Like right now, everybody's all about the AI stocks or Bitcoin or even just the S&P 500. Like everything's been just on a tear, just going nuts. And that's awesome when it's good. But when it's bad, those are the things that are dropping 20, 30, 40%. And so I like to have a portion of my portfolio in something that's going to be a bit more stable and less volatile. So for me, that's it, like the safety aspect.
Yeah, and that actually brings up a really good point. So just kind of getting, and I won't go too deep into this, but just kind of getting a bit more into where the dividends come from. You know, if you think about a normal company like a Procter & Gamble or Microsoft or Coca-Cola, companies pay their dividends from their free cash flow, which in essence is literally just the leftover cash that they have at the very end of the day after they've accounted for all their expenses and taxes and capital expenditures. And it's exactly what it sounds like. It's the free cash flow that they have to do whatever. They can just save it in the bank, stack up cash on the balance sheet. They can pay down debt. They can buy back shares. They can make acquisitions, or they can pay out dividends. And really the only way for a company to have free cash flow, and just kind of a sidebar, it's good. You want to invest in companies that are generating free cash flow and preferably growing free cash flow.
Right.
And that's another reason why I'm so big on investing in dividend paying stocks specifically, is because really the only way for them to afford the dividend and sustain and continue growing it is if they're generating free cash flow, and if that free cash flow is growing. So I also, and it's not like causation, it may not even necessarily be correlation, but I like to think that dividends can kind of indicate that you're investing in a business that is at least profitable. And at the end of the day, I think if you're a long-term investor, those are the type that you should be seeking out. So that's a great point that you bring up. And that is another reason why I gravitate towards these, because I just think, generally speaking, they're probably more financially responsible and able. You know what I mean?
Yeah, totally. I totally second all of that for sure. And speaking of investing, so tell us a little bit about your portfolio. Compiled it all here for you in this course that's normally $129, but for a limited time it's on sale for only $79. I put together the 17 videos you need to know to learn everything there is in dividends, from fundamentals to understanding DRIP to dividend yield and how to track your portfolio, then everything you need to know about how dividends are taxed. You're always going to have access to these videos and can refer back to them when choosing the newest dividend stock or ETF. Click the link down in my description at the end of this video, because this is the only course on dividends that you're ever gonna need. Speaking of investing, so tell us a little bit about your portfolio as far as just like percentage breakdown in your portfolio. What does it look like as far as individual stocks versus ETFs versus, like, is there anything else that you kind of have? Like what percentage do you kind of go with?
Yeah, you know what? I'll give you some exact numbers right now. Bear with me as I pull this up, and it's right here. I
like it.
I have it right here. So, and just for context, I have two different accounts, guys. I've got one taxable brokerage account, and in there is all my individual stock positions. And then I also have a Roth IRA that I invest into every single week. And my Roth IRA is just SCHD and VU. So it's just those two ETFs. One's a hands-on portfolio. The other's obviously passive and very hands-off. Now, at this point, I started my Roth IRA considerably after I started the taxable, so it's not the majority of my portfolio by any means. So at this point, I have about 17% of my portfolio in ETFs. The rest are in individual companies. But the individual companies I own, it's really nothing too crazy. I mean, I have Procter & Gamble, Lowe's, Snap-on, Johnson & Johnson, Starbucks. So these are all, for the most part, very, very recognizable and profitable companies. But with that said, the two ETFs that I own are some of my largest positions. Like SCHD is my number one largest position. And VU, the S&P 500, is, I think, my fourth or fifth largest position.
Okay.
And it's really only a matter of time before that becomes my number one or my number two. So like I said, I'm investing in both of those every week. And my goal, it's not this way because I did it kind of backwards, I feel like, but my goal is to make those two the largest and have ETFs become an increasingly larger percentage of the portfolio. But it's going to take some time to get there.
Interesting. So in your taxable brokerage, do you invest at all in ETFs, or is it all individual stocks there?
No, it's all individual stocks. And I've kind of thought about at some point maybe adding some ETFs, because over time I've slowly been consolidating some of the individual positions. Just as I learn more and as time goes on and I get more experience, I think I'm able to just get some better clarity on what I actually want to be investing in and what I think is a good investment. And so in doing this slow consolidation, I've thought, how do I want to reinvest the money? If I sell out of a position, where do I want to put that? And there's times where I think that if I don't know what to do, it would not at all be a bad idea to just, put that in something like SCHD, or maybe even just continue building out VU or something like that. If I can't think of a better place to put it. So that's an idea that I've chewed on. I haven't pulled the trigger on it yet. But But yeah, for now, it's just individual positions in the taxable account.
Take us through why specifically do you choose individual stocks, or the vast majority of your portfolio? It sounded like what, 83% of the entire portfolio is individual stocks. So why do you choose individual stocks? Why should somebody possibly, have that higher?
Yeah, so I apologize in advance because this might turn into a little bit of a rant, and let me start this off by saying I feel that I did it backwards. When I started investing, I've been at it for close to 5 years now, or coming up on 5 years. Excuse me, guys, I'm so sorry. Something in this tea. But so I've been investing for coming up on 5 years now. And when I first got into investing, I had no idea what I was doing. I had no experience with this stuff whatsoever, or accounting or finance or anything. I was coming into this a blank slate. And to learn about it, I just, hopped on YouTube and started learning. And as a lot of us do, I'm not saying that this is how it should be, but this is how it goes for a lot of us. I think a lot of us who started out the same way I do, you watch, these YouTubers who are talking about different stocks, and you kind of use that as your starting point. You kind of model what those people are talking about and what they're doing, what they're buying, because you really don't have anything else to go off of. And so when I first started investing, that's what I did. I went right into individual companies, like not knowing anything about what makes for a good investment or what to look for. And it worked out okay. I mean, I was still buying things for the most part that I think were pretty responsible, like some of the stocks that I mentioned: Starbucks, Procter and Gamble, used to have Coca-Cola, McDonald's. So it was a lot of those types of businesses that I felt that I understood. But at the same time, not knowing anything about this stuff, I had no business even doing that in hindsight. And I didn't know that at the time. I feel pretty strongly about that now. So, and like I said, I'm sorry, this is kind of a rant, but I feel like this is important context. So when I first got into it, I should have started with ETFs. I didn't. I went right into individual companies. And I've got to say, as time has gone on and as I've gotten more experience and spent more time with this stuff, I mean, I really love investing. I really love doing this. I really like thinking about these different businesses and what makes them tick. What makes Procter and Gamble, what do I think could make Procter and Gamble a good business 20 years from now, like it is today? What do I think what is it about Williams-Sonoma that I think makes it a good investment? I like thinking about these things. I like being hands-on and learning about these companies and learning about the process that it takes to analyze these as well. It's become a sort of hobby for me. And when I first got into this, I really didn't expect for that to be the case. But it has, in a big way. I really love doing this stuff and thinking about it. And like I said, I enjoy the process. And so I think that for me, that's the draw to investing in individual companies over ETFs. Yeah, it takes more time. It's more work. There's potentially some more risk involved and volatility involved in investing in individual companies over ETFs. But for me, it's something that I enjoy doing. I feel like I get a lot out of it. I've learned a lot these last handful of years that I've been doing this. I still have so much to learn, but I've really come a long way. And I don't know, I think it's been a really valuable learning experience for me, and it's been an enjoyable one. And that's what keeps me investing in individual companies. And it's worked out pretty well so far. And this could change down the road, but in the few short years I've been doing this, and I'm going to knock on wood because I think a lot of it's probably luck, but so far I've actually been able to outperform the S&P 500 on average since I started posting videos here on YouTube, at least, which really wasn't too long after I started investing. I think looking at the annualized returns, I think I'm outperforming the S&P by about 2 percentage points or so. Nice. On average over these last 4 or 5 years. And like I said, that could change, but so far we're off to a good start.
That's a really good start. Yeah. Nice job.
Well, thanks, man. I appreciate that. Watch, it's going to go downhill from here right after saying that. Totally jinxed it.
Of course.
But long story short, I've really come to enjoy the process. And I think when it comes to, and I think this is kind of like the overarching question in this conversation is, should you invest in individual stocks? Should you invest in ETFs? You'll agree that, and I think you're about to, you'll give us the other side, but the short answer is it depends. And it really depends on, are you curious about this stuff? Do you kind of like, Exactly what I just described, this whole process, is that something that sounds interesting to you, or is that something you just don't want to deal with? I think that really, I think investors need to really understand that about themselves, and I think that will steer you in the direction. Obviously, it's not mutually exclusive either. It doesn't have to be this or that or one or the other, which I'm sure we'll talk about. But I'll end it there. I've been hogging the floor, but I don't know. I've said a lot though. Like, does that make sense?
Yeah,
you
no,
think?
that totally makes sense, and it's good for me to hear your mindset. Somebody that invests with a little different. I mean, I have a lot of similarities. I mean, I obviously enjoy investing. I enjoy just business in general, obviously as a business professor. But I think that the way that we invest is a little bit different, and that makes a little bit more sense because you just truly enjoy, getting into the nitty gritty on like each and every one of those individual companies and finding something that, makes you excited or makes you tick about like this thing or whatever it may be. So I can definitely see the draw there. One question that I have before I talk about ETFs on my side is, what is the overall dividend yield that you're getting from your percent from the taxable brokerage?
I'll tell you the overall dividend stat. So my portfolio's yield there is about 3.5%.
Okay.
Not too high, not too low. I think that's a pretty moderate yield. And my weighted average dividend growth rate, my weighted 5-year average dividend growth rate across my portfolio is 8.7%.
Nice.
So I think those are very well balanced dividend stocks, a nice moderate yield with a pretty respectable dividend growth rate as well. It's actually really not too different than SCHD. In fact, SCHD's got the advantage in the dividend growth department, and maybe even the yield right now. I don't know what SCHD's yield is, but that's what we're rocking with as far as dividend stats.
So that's what I was going to just throw at you. SCHD is doing like basically that exact same thing. And so what I was wondering is, I talk with some dividend investors and they're investing in a little bit more risky type things, maybe a little bit higher yielding of individual stocks in order to beat like an SCHD, try to get something like, I don't know, something like a JEPI or something at 7, 8, 9%. And that's kind of the reason why they're investing in individual stocks versus an ETF, because at the end of the day, the ETF is somewhat capped. Like SCHD is not really going to go above 4% of a dividend yield, The growth rate is still there, and so your yield on cost is going to be nice, but the actual dividend yield itself, if you want to increase that, it's going to be tough to find with like an SCHD. So, so I mean, knowing that your portfolio is very similar to SCHD, is there ever just like a little piece of you that's just like, I'll just throw it into SCHD and be done with it. I don't got to worry about it anymore.
Yeah, that's such a good question. I mean, at this point, I'd be, especially having said everything that I've said about how I got into investing, how I would do it differently if I could go back. Having said all of that, yeah, I'd be lying if I said there hasn't been a time or some times where I've thought about just going all in on SCHD or ETFs in general.
Yeah.
But like I said, man, this is my thing. I have a lot of fun doing what I'm doing, and I think as long as that's true, I'm just gonna keep rocking with it. And if that ever changes for some reason, I can always switch it up then. But for the meantime, I really enjoy doing this stuff, and I feel like I get a lot out of it. And until that changes, I'll still have some individual stocks. You know what I mean?
Yeah, and I think at the end of the day, you always can customize it, right? Like if you wanted to, if your goal for the next couple of years is, no, we're going to crush SCHD, you probably could do it. You get the higher dividend yielding stocks, and then you just like keep an eye on them to make sure they're not cutting their dividends and things, and you probably could outperform it, but that's not your number one metric in my opinion, probably based off of what I know about you. So yeah, no, that was just something that was interesting because mine's short and sweet, but the reason why I'm investing in ETFs is just because I want to do other things. Like I do like to invest. I like doing math. Like I love numbers. I love geeking out about this stuff, about finance with people. But I also just like to do other hobbies, and I like to, for better or for worse, I'm always working 7 or 8 jobs at one time. And like, I just really like to do different things throughout the whole day. And so I just don't love it enough to stick my head in a book or research this kind of stuff for hours and hours on end, even though it is interesting to me. So for me, I'm like totally okay with the market return, and for me, the more of the game on my end is like, okay, getting a market return of like, anywhere from 8 to 12% over 20, 30 years, I'm good with that, especially if I can crush it in some side hustles and some other businesses, get more money to throw at that 8 to 12%. And now the capital's growing. That's where the money's made, in my opinion, rather than, for me at least, looking for something that's getting like 13%, 14%. Instead, I would like to use that time to go make more money and to like do something with it. So for me personally, ETFs have just become something where it's just like, yeah, like that's an awesome return. That's a lot of safety. There's so much diversification there. And then if it's a good ETF, like obviously the S&P 500 is my favorite, but SCHD would be right there, because the way that ETF is put together is just so smart. It was engineered so well. There hasn't been many ETFs that I like as much as those, as far as algorithmically. So that's kind of my way of investing.
Absolutely. And really, I mean, the same is true with VU, with the S&P 500 in general, let me say.
Yeah.
It's hard to beat. And if you just think about the methodology behind that index, it's survival of the fittest. Okay. It's the best businesses, it's growing businesses. If there's one that's lagging, or if one of them starts sucking, then it gets removed and gets replaced with a new up and comer. So it's designed to really just like continue growing in perpetuity, unless there's, I mean, over a long term, I shouldn't say in perpetuity, but over a long term, you really can't lose. So yeah, it's kind of a no-brainer. And that's not lost on me at all. And I think what we've pretty much established in this conversation is there's more than one way to skin the cat, as I like to say. There's more than one way to do things.
Yeah.
And I don't want to be too dogmatic about the way that I do things either, because like I said, I'm still learning so much about this stuff, and I learn something new every day. And the strategy could change as time goes on. And I think that's just part of the fun of just doing this at all and being on this investing journey, is just to see how it develops and how you as an individual develop with it. Because in a sense, like, your portfolio kind of is an extension of yourself and the way that you see the world and what you want out of your investments. And so I think it will be really interesting to continue to see that evolution and what it looks like. And I guarantee you it'll be different 10 years from now than it is today. So yeah, it'll be interesting to see what that looks like.
No, definitely. And I mean, you've beaten the S&P 500. So keep going. And I love it.
I mean, I'm basically Warren Buffett at this point.
I wasn't going to say it, but I guess since you said it.
Yeah, you were thinking it.
That's true. I think a little more handsome version, but yes.
No, thanks, man. Obviously we're joking, guys.
Yes. Okay, so I guess, I do want to ask about a couple of stocks that you're interested in for 2025, a couple of dividend investing individual stocks. But right before that, I'm kind of curious, since you just kind of like dropped it on us, and you said that your portfolio is built out, you have a taxable brokerage that's all dividend investing, and then you have a Roth IRA that is ETFs, and half of it is a dividend ETF, and half of it is a foundational ETF, or the market average ETF, right? So my question is, why have you decided to keep dividend investing within a taxable account when you know that one of the main harps on dividend investing is, I got to pay taxes every single time that I, have a dividend come out. So why wouldn't you kind of flip-flop that and swap it and make the Roth your dividend investing, and make maybe the taxable brokerage more of like the S&P 500 or something like that?
That's a really good question. And I want to know what you think about this too. Because I could be tripping on this. And this is another one of those things where I do think there is more than one way to skin the cat. I like the flexibility of my taxable account. I think that's pretty big for me. And with the Roth IRA, you can't start withdrawing the profits or the income until you're almost 60 years old without penalty. I plan on starting to use my dividends like long before that. And like, just to give you some context, and this is, or just to give you an idea, and this is another one of those things that could change down the road, but this is where my mind is at today. I've told myself that I want to maybe start using some of my dividends to pay bills, or, pull them from the portfolio, maybe around the time that I get to a point where my portfolio is bringing in about $2,000 per month on average. And I know, I already see in the comments, $2,000 isn't gonna even pay anything in the future, inflation and all that stuff. And I totally get it, guys, but like, a couple $1,000 coming in passively, I'm not gonna complain about that. But my mindset
for that.
What's that?
For that one, I just get hit with that all the time. I'm like, okay, would you rather have $2,000 a month or zero? Like,
yeah, it's a no-brainer. It's a no-brainer. And it is what it is. Like, that's just one of those things that you can't control, obviously, too.
Yeah.
But with that said, at the rate that I'm contributing to my portfolio, which is actually going up over time, I'm actively working to increase my contributions and invest more as time goes on. But at the rate that I'm contributing today, I should be at that $2,000 per month mark within the next, honestly, within 15 years or less. And I'm only, how old am I? 30. No, I'm 31. Holy cow. So I'm 31 years old.
Welcome.
And which means that I should hit that point by the time I'm, maybe somewhere between 41 and 45. That's almost, that's basically a decade and a half before I'd be able to use anything in my Roth without incurring penalties. And so that's where having that flexibility comes in. That's where that becomes important to me, because just based on my timeline and what I'm looking to get out of my portfolio, I just think it makes sense. And I want to have that option down the road. If that's what I decide to do, I want to be able to do that. You know what I'm saying? But at the same time, I want to balance that out with my Roth IRA, because, if life goes the way it should, I will be 60 years old someday. And at that point, I'm still going to want as much tax-free profits and as much tax-free income as I could get my hands on. And that's why I still make it a point to max out my Roth IRA. Given what I just said, where it's like, I want to use my dividends sooner than later. That's true. But I also still need to make decisions today for, the future version of myself 30 and 40 and 50 years into the future.
Right.
And so I still think it's really important to not neglect the type of portfolios, tripping over my words, that are, tax beneficial, like the Roth IRAs or even the 401ks. I think those are important too.
Yeah.
I don't know. What do you think about this approach? I'll give it back to you. Does that make sense? Or
yeah, no, totally.
am I out to lunch on that?
Totally makes sense. And it's something that I deal with all the time. Obviously, I have students who are 18 years old and they're talking about investing in certain things, and they can't even conceptualize this idea of them turning the age 60. So they're like, I'm not going to invest in a retirement account. But compound interest is their best friend at this age, because you could put away $50 a month and turn it into $1 million. It's just crazy. But all that to say, I tend to follow suit with you. I tell people you need to have short-term, medium-term, and long-term outlooks, right? Same thing with business. If you're going to start a business, you need to have a couple of things you're going to do this week, then a couple of things you're going to do in this quarter, and then what are we going to get done by the end of the year? Because you're not going to get that thing done by the end of the year if you don't do the thing that you need to get done by the end of the week, right? So same thing with investing. You got to be able to look at, okay, yes, I do want the nest egg. I want to be able to live off of my investments at age 60, 65, whatever it may be able to slow down and just enjoy life at that point. But I also want to enjoy life maybe a little bit sooner than that if that works out for me, right? And so if you can put yourself in that situation to be able to do that, then by all means, go for it. I think that the only knock on that strategy would just be well, you're paying an unnecessary tax or a tax drag to get you to that point to a certain extent. But the only way that you would be able to do that strategy without the tax drag, but still be able to use it at age 45 or so, would be if you invested in growth stocks or maybe the S&P 500, let that thing grow to, a couple $100,000. And then at that point, you'd have to sell that full amount out, put it into dividends, And when you do that, you're going to incur that same amount of tax that you would have paid incrementally along the way. So
with the tax drag, though, this is how I think about it. I could be wrong. But with the tax drag, that's okay. So just so I know what that is, that's basically where you don't get the full compounding effect because a part of that theoretically goes to taxes. So it's less being reinvested or less compounding. Is that what that is?
To a certain extent, but it's more so the idea that you're paying the taxes because it's not really messing with your compounding effect, right? Like, I mean,
right.
the money's going.
If you're reinvesting your dividends,
yeah.
Then yeah.
But it's just that you are reinvesting the dividend, but then you're paying the tax on the back end through, based off where your income is or whatever. And it's a 15%. Like for most people, it's really not the end of the world, but it's just something. And so some people, though, that are higher income earners, if they're making $500,000 a year, that just may not be the best move when everything else they're trying to do is bring down their taxable income.
Yeah, well, a couple of thoughts. Number one, I'll tell you right now, that's not a problem that I have to worry about yet.
Yeah, not yet.
Hopefully it's a good problem to have, right?
Yeah.
And that kind of leads me to the next thing. It's like making more money is not a bad thing. Having a higher income is not a bad thing. It's and this is maybe like a low-hanging fruit response, but if you are you're not going to turn down a raise at your job just because you have to pay more taxes on it. So, I don't think that's really all too different than making more dividend income and potentially paying higher taxes on that. And another important thing to keep in mind is, your taxes, the income taxes that you pay are not just determined by like your dividend income. You have to look at the holistic picture. You've got your W-2 income, you've got your investment income, you've got whatever deductions you have too. So there's really more to the story, and there's really more to your overall tax profile and the tax burden at the end of the year besides just how much you make in dividends.
Yeah,
so right. I think that's often left out of the conversation as well.
You're right. Yeah. Looking at things in a full holistic lens is very important. We can't just look at one thing and say, well, that's bad, or this is good or bad. Well, it could be good or bad based off of the rest of whatever else is going on. So I like it.
Well, that's the thing about investing. It's such a complicated thing. It really is. There's so much to this stuff, and it can be a very intimidating thing too.
Yeah.
Which, thank goodness, like we live in a day and age where all this information is like readily available, and there are easy investment vehicles like ETFs that make it so easy to build wealth and get skin in the game. But because it is so complex and it's so complicated, we like to simplify things down as much as we can to either or scenarios. It has to be this or that. It's got to be black or white. And really, when it comes to a lot of this stuff, there's so much gray area. There's so much nuance. And that's why I just go back to that phrase. There's more than one way to skin the cat, and there's more than one way to do things. And I think we do ourselves a disservice by thinking things have to be our way or the highway, or one way versus someone else's way, because there's just so much in between here.
I would agree 100%. I love it, man. Well, let me switch gears a little bit here, and let me get your thoughts on what are, give me 2 or 3 good individual stocks that you're looking forward to in 2025. What it doesn't have to be anything crazy. You don't have to give us any specs or all the technical analysis on it, but just maybe a little quick 30 seconds on why for each one. But what are 3 that we should be looking for?
Okay. And I want to hear yours after too, by the way.
Okay.
So the first one that comes to mind for me is Visa. Okay. I think Visa is just like the gold standard. If you look at the financials, before we even get to that, just think about the company. They are a payment network. They are a toll booth. Every time you swipe your card or tap to pay, Visa gets, or even MasterCard as well. That's another symmetrical option. Or American Express, one of the 3. I like Visa. I have Visa, but I just really like the model. It's a toll booth. They just get paid, when people pay for things. They basically help facilitate that transaction. It's a very easy thing for them to do, and they're basically getting paid to facilitate that, to have that network, that payment network. And people are only using their credit cards more and paying digitally more as time goes on. People aren't using cash nearly as often as they used to, and it's becoming easier and easier to pay with your card or whatever you have. So I think it's got some pretty good qualitative tailwinds there. But if you also look at the financials, everything's straight up into the right. The revenue growth, earnings per share, free cash flow, guys, It's truly a work of art. And there's really no debt. I mean, they have some debt on the balance sheet, but the amount of free cash flow that they have coming in 1 year more than covers the outstanding debt that they have. So it's really not much of a concern. So I think there's a lot to like about Visa, and it's also a very easy to understand business too. Like, we're all pretty familiar with it. One misconception though, and I'm sorry, I know we got to move on to two more. One misconception about Visa though, that a lot of people don't understand, is they actually are not responsible for credit card debt. You know, we hear that a lot. Credit card debt for people is at an all-time high. People are at risk of defaulting on their credit, stuff like that. Visa's actually not on the hook for that. The businesses that are on the hook for that consumer debt, credit card debt, is the issuers, is what they call them. And that would be like your bank, for example. So just for example, I have a Southwest credit card. The card itself is Visa, which means that the transaction goes through Visa's payment network. But Chase, JP Morgan Chase, was the issuer. They're the one who issued me that unsecured line of credit. So if I don't make my credit card payments, they are basically on the hook for that debt. I owe Chase, you know what I'm saying? And so that's one big misconception I see about companies like Visa and MasterCard, which I think is a competitive advantage. American Express, it's a bit different. So Visa's number one. Number two, this one is, I call this one my great white whale. This is the one that got away and keeps getting away from me. This is a company called Rollins, ticker symbol ROL. And Rollins is one of the world's largest pest control companies. And pretty similar, just thinking about the financials for Rollins, very similar in nature to what you'd find with Visa. Growing sales very consistently, earnings per share, same thing, and free cash flow. Very minimal debt. So very similar financial profiles. I think it looks really good. Great dividend growth stock as well. And I didn't really mention that with Visa, but Visa, really solid dividend growth rate. I think about 15% on average over the last 5 years. I think Rollins is somewhere in that neck of the woods as well. Both have low starting dividend yields, but guys, we've got plenty of time to let that dividend grow and compound. We're not in any rush here, okay? So dividend growth is good. And Rollins, you know, being a pest control company, the way I figure, there's always going to be things like ants, spiders, you know, termites, snakes, and you know, there's always going to be critters that are getting into places that they shouldn't, cockroaches. And so because of that, there's always going to be a need for a company like Rollins.
Sure.
So that's one that I'm really, really hyped on. And I don't have it in my portfolio yet, but I really, really want to have it at some point. I might just have to bite the bullet. And then this next one, I think the verdict is still out on this one. This is the newest addition to my portfolio. It's a company called Clear Secure, ticker symbol YOU. And this one's a bit under the radar. But you guys might be familiar with this company, especially if you've done any traveling. So if you go to the airport, you get in the TSA line, they check your boarding pass and your ID, then you go through the security gate. Well, and a lot of you guys know too, sometimes that is a nightmare. Sometimes that line is just crazy. You're in it for a frustrating amount of time, and it's just a miserable experience. Clear Secure is, they actually let you bypass all of that. And typically the clear is right next to the line that I just talked about. And there are these kiosks. There's these blue and white kiosks, and it's basically like a biometric identity verification business. And so you can pay to be a Clear member and go through that security process through the Clear lines, where it's going to be less busy, it's going to be faster, and so essentially it's speeding up that process. But it's not just airports. I mean, that's their bread and butter. They also offer biometric identity verification, which I think is probably a growing industry as time goes on. You know, cyber attacks are more. Well, I guess identity fraud is probably easier to do these days. And that's getting worse. But anyway, what I was saying was Clear is not just in airports. They're also expanding into like event venues. So similar idea, but if you go to, like I live here in Las Vegas, you go to Allegiant Stadium or T-Mobile Arena, and if you want to get into the event, instead of waiting in the line for them to check your ticket, you can just, verify your identity there with Clear, get right in. Typically it's a bit faster. And they're expanding into other areas as well, like healthcare, finance. So They actually even have partnerships with companies like Uber and LinkedIn to verify identity. But essentially, it's a frictionless, secure way for identity verification. I'm hoping that will be, I mean, so far it's been a very fast growing business. And I hope that continues. But I will say this one is probably the riskiest company that I've mentioned here. And it's also probably the highest risk one in my portfolio. And the reason being, it's a very young company. It only came onto the market in 2021, I believe. So it's only been around for a few years publicly. And it's a very fast changing industry as well. And I would say that that's one of the risks, but they do have some competitive advantages like brand and, you know, their various partnerships. They have a big partnership with American Express. So they do have some things working in their favor that I think help protect them from competition and other things, and regulation as well. That's both a pro and a con. But that's another one that I have and am actively buying. But yeah, I'm really looking forward to seeing how this next year, how these next few years play out for that company. It could go, it's either going to explode or it's going to implode. I think I have more reason to believe it's going to be the former than the latter, but we'll see what happens.
Yeah. No,
Sorry for the tangent there.
No, it was close. I asked for about 30 seconds on each one. You were real close. That was great.
Oh, okay, good.
No, you were not close, but that was really, really good stuff. I've seen a lot of the clear at the airport recently, and I'm like, what the heck are those things? But if something is there that's going to make something more convenient and get people out of lines, and people start to know about that, like, that's where it's at. So that type of a business, any type of business that you're able to give somebody convenience, that's a smart move.
And with that said, guys, do not buy these stocks just because I've given you a quick, like, gibberish-filled rundown of them. Please,
yeah,
definitely do your own research. But these are the ones that I'm looking at. I own 2 out of those 3. The only one I don't own is Rollins. I will own Rollins at some point, but definitely do your own research. But yeah, those are a few that I'm really excited about.
Yeah, no, I think that was a good little disclaimer. I think hopefully for those of you that are watching this, you're smart enough to know that no matter who's talking about it, whatever credibility they have, they might just be investing in that for themselves, for their portfolio, and it might make sense in their portfolio, but it may not make sense in yours. So definitely do your own research. But yeah, for me, I'll just give one because I don't.
Used up all our time.
No, well, that too. No, because I don't really have too many individual dividend stocks because, again, I'm more of an ETF investor. I mean, 93% of my entire portfolio is ETFs. So I just have these little bit of individual stocks. But one of my biggest holdings is Microsoft. And so Microsoft is one. Obviously, you and I have talked about this. I think I say this in every one of the videos with me and you. But I just, and most people then in the comments say that's not a dividend stock. But it's one of the top dividend growers. That thing has been on fire. Obviously, it's a very small dividend. It's like 1% or less. That's because the share price keeps growing like crazy. But the growth of the actual dividend itself, it's a pretty solid thing. And we're starting to see it in the tech world. Google just announced a dividend. Apple's had a very small one. NVIDIA technically has this 0.0003% or something. So these tech companies, they're trying to keep their investors, and giving them some cash every once in a while is a good way to keep them. So anyway, Microsoft, I mean, everybody knows what it does, but the AI play, they're number one in their space, obviously not the hardware like NVIDIA, but they have made the biggest investments in AI, $10 billion so far, and that's just what we know of. So we know that whatever Microsoft does, they do it well, and whatever they have in the works is going to be crazy. And I just believe in that company wholeheartedly. So that's the one that I would pick. But as far as dividend ETFs, I really just stick to SCHD. I mean, in my videos, I talk about SCHD and VYM from Vanguard somewhat synonymously, and they are close. It's just that SCHD beats it in a couple of ways. VYM's actually beat them in appreciation in a couple of ways as well. But long term, what I care about, and I think what you care about, is the dividend growth. I think that is just the superpower in this dividend investing world, because hopefully none of you are investing in dividend stocks or ETFs for like 1 year or 2 years. The idea is to get in at the floor, like your floor possibly, and be able to hold it for 10 years. And at that point, the dividend will have grown so much based on how much you had bought it in for, that your yield on cost, which is what that's called, is so low at that point that it's almost like a steal. You're getting such a high dividend for what you actually paid for 10 years earlier. So for me, SCHD is just such a solid dividend growth type ETF. But then again, just the actual buildup of the ETF. I was a little mad when they kicked out Broadcom. That was one of my favorite companies that was in SCHD. And there are a couple laggards in there that I would wish weren't in there, obviously, but they're also companies that I would never think to invest in, and they're not within the other parts of my portfolio. So I can appreciate the balance that it gives my portfolio. So that's kind of where I stick.
Yeah, man, it really is hard to beat SCHD, and I think we're both such like SCHD fanboys, but it's really hard not to be. And there are some other really good dividend ETFs out there as well, like VYM. DGRO is another really solid one. There's a handful of really great funds, but as far as the total returns with the current dividend yield, with the dividend growth, it really is the full package. I think VYM is pretty close too.
Yeah.
And I really don't think you can go wrong with any of those. So that's it's just a great choice, man. Yeah.
I would agree with that. Thanks. All right. Last question. If you were advising somebody new to the world of dividend investing, so maybe you 5 years ago, what would you tell them? How should they proceed?
Yeah, this is great. I would encourage any new investor, as painful as it might be and as boring as it might be at first, I would really encourage you to just start with ETFs. Okay, just build a good diversified foundation with the VUs, the SCHDs. Do Professor G's 3-fund ETF portfolio.
Nice.
Great way to start. I really trust me. Learn from my mistakes, please. Someone should, and just walk before you can run. Okay, and so that'd be the best piece of advice, I think. Just go in ETFs. And if you start to get the itch, because some people right out of the gate, I think I was like this. Some people right out of the gate, they want to just go into picking stocks, and I get it. It's sexier, it's cooler, but if hold off on that, please. Just be patient. Just get some skin in the game, develop some discipline and consistency, and just contributing to your portfolio with the ETFs. And if you really want to pick some individual stocks from there, fine. But just right out of the gate, don't go 20, 25, 30 different stocks, just cherry picking these ones you see on YouTube. It's not a good way to go about things. It's so easy to do. But yeah, you got to walk before you can run. And I think too, let me share something with you guys real quick. Excuse me. Let me get this right here. Now, hypothetically, if you were adamant on just picking stocks and at some point buying individual companies, I think you definitely need to pick up a copy of this book right here. I don't know if you can see it, but this is Warren Buffett in the Interpretation of Financial Statements. This has been a game changer. This book will teach you how to read the 3 financial statements: the income statement, the balance sheet, and the cash flow statement, which is an essential skill to learn if you're going to be investing in individual companies. This book breaks it down so simple and so straightforward. Even a simpleton like myself, who had no experience coming into this, could understand by going through this book. And I flip through this, I try to make it a habit to read a chapter every day, or read a page or two every day, because each page is basically like a line item on the financial statement. So it goes through it step by step. Get a copy of this. It'll really get you started on the right foot. And I would say don't buy any individual stocks until you read this book.
I like that. I like that a lot, actually. That goes along with what I say. Do your research. And that book's actually a book that I use in my finance class for my finance students. So that is a very solid recommendation, my friend. Well, thank you very much, man. This has been awesome. I actually learned a lot. I didn't know that about Visa, and so that was pretty cool. So thanks so much, and appreciate you, brother.
No, thank you, man. And thank all of you guys tuning in, too. I really appreciate the opportunity to do this, and it's always good to hang out with the Professor G.
We love you, brother. All right, man. I'll talk to you soon.